Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today I'm talking with Ron Diamond. How you doing today, Ron?
I'm doing terrific. Thank you.
Great. Well, I brought Ron on because there's this trend in family offices going on that I really wanted to touch on, and it's something that's not really talked about all that much, but it's really important. So, Ron, maybe you can tell us a little bit about your background.
Graduated Northwestern, worked at Drexel Burnham, thought I was going to be there for 40 years. Drexel imploded, came back to Chicago, started a hedge fund, ran it for 10 years, sold it, and started investing. And what we currently do is we work with about 100 single family offices, ranging anywhere between 250 million to 30 billion, and we invest in the private markets. I kind of act as a funnel, so private equity, venture capital, real estate, credit.
Nice. So, I know one of the things you talk about are the trends that are going on in family offices. So what do you see in the family office space right now? But actually, you know what? Let's start with this. What is a family office? Because there are a lot of listeners who may not even know what one is.
There's a lot of family offices that can't really answer that question. I gave a keynote at Stanford 4 years ago, and I had $5 billion families speaking. And I just asked the question. I said, what's a family office and why did you create it? And I had 5 completely different answers, and nobody was wrong, nobody was right. It's just kind of where we are. So, family offices, there's roughly 17,000 family offices throughout the world, controlling roughly $10 trillion in capital. And then when you combine that with the fact that in the next 15 years, you're going to see 65 trillion of assets transfer from the baby boomers to the next gen, which will be the largest transfer in the history of the world taking place in 15 years, this family office market can get massive. And just to put it in context, there's currently $4.5 trillion in total in hedge funds throughout the world. And this market the family office market will soon eclipse private equity and venture capital combined. So it's a massive market. Having said that, it's very fragmented, very inefficient, very siloed, and we're maybe in the third, maybe the fourth inning in the evolution of it.
So what are the advantages of somebody using a family office as opposed to just, putting their money in some other assets? Like what's the point?
Well, the biggest advantage that family offices have is something called patient capital. And I think what's happening is you're starting to see a trend as private equity and venture capital disrupted the public markets in the early 80s, because again, it was a better model. I used to run a hedge fund, and you couldn't run your business if every 90 days you had to report to me or different analysts how to do it. It's not a good model. So private equity and venture capital, the model made more sense because basically 2% covers the overhead, 20% I only make money if you make money. And from the 80s on, the market just exploded. I just did an interview with David Rubenstein yesterday, and who's the founder of Carlyle, and he talked about how the industry literally just went from nothing to becoming massive, and it's becoming larger and larger. I believe that family offices, as private equity and venture capital disrupted the public markets, I think family offices are starting to disrupt private equity and venture capital. Now, when I say starting to, they're not there yet, and there's a long ways to go. But in general, the biggest advantage that family offices have is something called patient capital. And if you think about it, it all really goes back to alignment of interest. So the private equity and venture capital models, in my opinion, in general, many of them it's become an AUM game. The funds have become too big. And, one example which crystallizes this is I had a friend who did a roll-up of logistics companies, great track record, needed $150 million. Placement agent was able to get him $500 million. He said, terrific, I just need $150 and let's get started. The placement agent literally came to his house in New York and wrote down 2% of 500 million equals X, 2% of 150 million equals Y. What am I missing? And my friend, who's a bit incredulous, scratched his head. He said, what you're missing is if I do what you want me to do, there won't be fun too, because I can't perform. I can't I can't allocate 500. I can only allocate 150. So I think that's a microcosm of what's wrong with the industry. And again, I'm generalizing. I do invest in private equity funds. I do invest in venture capital funds, but in general, they've become too big. It's become an AUM game. So I think family offices, which have patient capital, they're not incented to flip companies every 3 to 5 years. So in many instances, they're better partners in many instances than the family office, than the private equity or venture capital firms.
Yeah, but isn't the point to make money? And if these private equity firms are trying to, flip capitals every 3 to 5 years, isn't that the most effective way? If it wasn't, wouldn't they not do it?
Oh, so let's look at through which lens you're looking at. So let's say you own a widget company and it's third generation widget company. If you're looking to sell that widget company for the most money, 99 times out of 100, a private equity firm will pay the most money. Period. End of conversation. The family office is probably not going to be in that because they typically don't get into bidding wars. The reason you want to work with a family office is, let's assume that this third generation company wants to be fourth and fifth and sixth generation. And let's just assume that there's employees, 50, 75, 100 employees that they care about. They're much more likely to work with the family office because they look at it from this perspective of long term. And family offices do not have to flip companies every 3 to 5 years. They could buy a company, hold it for 10, 20, 30 years, and not sell it at all. So for the company that's looking to partner or to sell, if they're looking for sustainability, in many instances, the family office model is a better model if it's efficient and they have enough people on staff to support it.
So let me ask the obvious question then. If they're just looking to partner with these firms, with these private companies, why go with private companies? Why not just go with a public company if they're going to just, basically look long term for investments? Looking at private equity or venture capital as they're looking to find a quick flip or a liquidation because the multiples, they can get better multiples, but public companies have higher multiples. So I guess the question would be is, why bother at all with private companies? Because there's a liquidity issue.
Yeah, but there's also a liquidity premium, and it's very difficult. I ran a hedge fund from 1990 to 2000, and it was much easier to create alpha in the public markets. I think today it's really difficult to create alpha in the public markets. That's why we invest in private equity, venture capital, real estate credit. I think I just have money invested in index funds, and I would argue with people. I'm fairly confident that I'm right, that that's a better model to do it. But you can create alpha in the private markets, which is the private equity, venture capital, real estate, and credit.
Okay. So now, let's talk a little bit about the trends of family office getting into, private equity and venture capital a little bit more. I've talked to a lot of people who are in that space, and I'm hearing that it's not just about the numbers. Like sometimes it's impact investing, or there's other reasons for doing that. Can you speak to kind of like the trends in that area as well?
Well, in impact investing, it is real. Roughly a third of family offices are investing and do some sort of impact investing. It'll probably go up to 50% in the next 3 to 5 years, and it's driven primarily by the millennials or the younger generation up rather than the older generation down. When I was younger, if I bought a pair of jeans, I don't look at the back of them to see where they were made. It's not that I didn't care. It's just that I didn't have the internet and I couldn't have access to that information. I've got beautiful 19 and 22-year-old daughters, and if they buy anything, they want to know who makes it, where's it made, how do they treat their employees? They've got the internet. So I think because of the internet and because of technology, this younger generation is much more concerned. They have much easier access to knowledge, and there's been pressure on these companies to do things the right way. So impact investing is a trend that is clearly going to continue and going to continue to get bigger.
Now, do you think, I've noticed with the low interest rate environment we've had for quite a long time, which has benefited a lot of private equity and venture capital firms. Do you think with higher interest rates that's going to change the dynamics? And if so, how does that impact the family office space?
It'll change it. Yes, the answer is yes, it will change it. I think that family offices are, again, they're starting, like I said, we're in the third or fourth inning in the evolution of family offices. So when you hear the word family office, a lot of people think Rockefellers or Vanderbilts, and that's what people think of as family offices. Today, you look at family offices like the Pritzkers, the Crowns, the Dells, they've kind of institutionalized it, right? They can compete directly with the Apollos or Blackstones of the world. Most family offices can't. Most family offices, because think about it, where'd they make their money? They sold Beanie Babies. They sold 5 Hour Energy or Guess Jeans or Giorgio Perfume. They had a liquidity event. It's a completely different skill set to do that, which I couldn't do, than to take $1 billion, grow it to 2, not spoil the kids, do some estate planning, do some wealth transfer, and grow the asset base. So you've got huge amounts of money in general, in general, very inefficient hands. That's starting to change. And the beauty, what I love about this industry right now, I think we're at an inflection point. We are at a tipping point right now. And I do believe that again, private equity and venture capital will never not exist. There'll always be huge markets. But I do think that family offices, as they become more sophisticated, as they start realizing how to compensate the people, as they start taking advantage of what they have over the private equity and venture capital firms, which is patient capital, they're going to slowly more and more start to disrupt these private equity and venture capital firms. And again, with 10 trillion in capital and 65 trillion coming downstream, it's a bigger market than the family office, than the private equity or venture capital markets combined. And every major bank, law firm, accounting firm, they're all trying to get into this market.
So you mentioned some of the larger family offices are more like institutions in themselves, and the small family offices or smaller ones that had liquidity events that are not from the financial background. How do they bridge that gap, right? Like, how do they bridge the gap between, being, let's say it's, I don't know, a few $100 million in family assets, and, how do they handle it? They don't have a financial background. Like, what do they do? How do they incorporate the asset management into the family office?
The short answer is many of them should be working with a multifamily office and not have their own single family office. I think a lot of the reason that family offices are so prevalent right now, part of it's driven by ego, right? That people want to have their own family office. But at the end of the day, when you think about it, if you're gonna really be a steward of the capital, you need, first of all, you need a certain amount of money to have it make economic sense to have a family office. I would argue bare bones minimum, you need 250 million, probably 500 million if you're going to invest in private markets. So you're going to vet private equity, venture capital, real estate deals. If you have less than that, that's why the multifamily offices were created, right? So rather than paying your own accountant, you share it with 20 other families. Rather than paying your own banker, you share it with 20 other families. So many of these single family offices, in my opinion, that are under 250 or 500 million should be multifamily offices. And I do think that's going to morph and it's going to change. What's happened is post-crash, pre-COVID, the good thing and the bad thing is everything went up. So the good thing is everything went up. So people made money in private equity, venture capital, real estate, credit, Bitcoin, whatever they invested in. And these family offices probably thought they were a little smarter than they were. There's a skill set to being involved in private equity and venture capital, a very important skill set. And as we head into a recession and a lot of these deals start to go downhill, a lot of these families that were making money no matter what they did, as we head into a recession, they're not going to be making that kind of money. And I think many of them are going to switch to more of a hybrid multifamily office model. Having said that, the big ones, Michael Dell's family office just merged with Byron Trott with BDT, and they're going to be able to compete directly eventually with the biggest firms on Wall Street. So it's a fascinating time, and you're watching something unfold in real time.
So what's the advantage for them doing that? I mean, other than ego and just growth, like why are they trying to compete with Wall Street?
Well, first of all, remember, 68% of family offices started since 2000, and half of that started since the crash. So this is a really new industry. Also, as a premise, understand 25% of family offices make it to the second generation, 10 to the third, and 5 to the fourth. So the model itself doesn't really work. So why do people do it? The reason many of the family offices started was trust. They lost trust in Wall Street. I used to run a hedge fund, and I had the ability to, if market conditions were as such, I could put up gates, right? Well, most people don't know what gates are. Gates basically means you can't sell right now because you don't want to have forced liquidity. So a lot of the reason family offices were created wasn't so much that they wanted to be their own money manager. It's just that they didn't trust Wall Street. And that's really what's driving this, right? So if you think about it, on the one end, the lower end, you've got the wirehouses who technically aren't even fiduciaries, which if you think about it, that's mind-boggling. And then on top of that, you had RIAs, which were registered investment advisors, which really started to scale in the last 10, 15 years. They're fiduciaries. So if they're going to bring a product to a client, the client knows that they might not make money in it, but they're not being sold that product because that person is going to make more commission, which is true with wirehouses. On top of the RIAs are the multifamily offices, and that's really where the biggest growth is. The multifamily offices are simply RIAs, but they look at the world through a holistic lens. So they're not just trying to create alpha. They look at things like estate planning, taxes, next gen, setting up businesses, trusts, and things like that. So they look at more holistically. And then the largest of them are the single family offices, where I would argue you really need 250 to 500 million in order to make it make economic sense. But it was driven not so much because they wanted to start, they all wanted to be money managers. It was driven because a lot of them lost trust and confidence in Wall Street. That was the impetus to drive many of these family offices.
I think that's fascinating, because personally I had similar thoughts about Wall Street, even though I work on it sort of. Is part of the reason I started running my own money is because I didn't trust anybody else to do it. I worked a few years at these wirehouse firms, and their job is to sell you stuff, and they don't care what they sell you as long as it's going to make them commissions. Those old commercials of "let's put that lipstick on the pig and go out and sell it" were spot on. So I'm glad to hear that that's why people are doing it. It kind of makes
it's not the only reason. It's certainly one of the reasons. But remember, my first job was at Drexel Burnham. And Drexel, if you remember, was like Goldman Sachs on steroids in its day. This is when Milken was with junk bonds, and they were just printing money. I remember this is my first job out of college. So I was 24 years old. And I remember my dad was a brilliant banker. And when you have a stock, it could be Drexel, you get a buy, hold, or sell, right? Those were the three different criteria for Drexel. And every stock that Drexel followed was either a hold or a buy, no sells. And I asked my dad, I said, why is that? He's like, you'll figure it out. And it took me about 6 months to figure it out. And the reason was because these are investment banking clients. And if it's an investment banking client and you're going to put a sell on it, they're not going to work with you. It's an inherent conflict of interest. So in totality, what's happening is if you go to the lowest common denominator, in my opinion, it all has to do with alignment of interest. People just want their interests aligned. And in general, Wall Street, there are many inherent conflicts in Wall Street, and alignment of interest is really the main driver of what's causing these family offices to explode, not to mention the fact that you've had more wealth created super quickly, and because of technology, because of the internet, you don't have to wait 2 or 3 generations to create a fortune like the Vanderbilt. You could create an app in a year.
Yeah, and then you mentioned the holistic aspect. They're basically holistic RIAs, which I would argue the RIAs, a lot of them are holistic. They just don't have the capacity as maybe they're on the smaller end of the family office and the larger end. But what's interesting is that when you have these multiple generation wealth, some of the challenges that kind of come into play, and I know we talked about it with Michael Sonnenfeld a number of months ago, but I'm curious, what other aspects, when you talk about the holistic side, do you see with these family offices? What are some of the biggest issues that they're trying to solve outside of just money management?
Well, look, a family office is a family, right? So they're looking to not just create alpha, which they're certainly looking to do. Many family offices are very philanthropic, right? So they're also looking to work in different areas that are important to them. And it doesn't matter what the philanthropy is. Several people are into climate change. You could be into education, poverty. It doesn't matter what you are. So I think family offices look at things as a way much more holistically, not just how can I create the most alpha. And that is part of the reason why impact investing has become so important. And that's also one of the bridges that helps to connect the different generations. The younger generation wants to invest in crypto and Bitcoin, all these newer technologies. The older generations maybe want to invest in more stable real estate type of transactions. One of the things that could bond these families is philanthropy. And I think one of my North Stars is you're starting to see family offices solve some of these real world problems. A couple examples, one of which is very personal. My dad died of prostate cancer when he was 57. My first boss was Michael Milken. Michael Milken developed prostate cancer. When he developed prostate cancer, rather than throwing $100 million into the American Cancer Society, he built like a VC fund. He put 250,000 here, 2 million here, 4 million here. And because of him, you and I and the male listeners will die with, but not of prostate cancer if we live long enough. That's one example. You look at what Bill Gates did for vaccines. I would argue he did more for vaccines than the US government. I don't think that family offices, you can run a philanthropy exactly like a business. But one of the things that excites me so much, and one of my North Stars, is I think you can run a philanthropy more business-like. And if you take these business minds, like look at what Milken did with prostate cancer and look at what Gates has done for vaccines, I think that these family offices are going to solve some of these real world problems, because it's not going to come from government. And it's not going to come from the corporate sector, in my opinion. A lot of these drivers are going to come from family offices. So to me, that's the most exciting part of where we are in the evolution of family offices.
Yeah, no, I love that. I think that's a great perspective. I've heard a few people make that argument many years ago that it's a shame when people build tremendous wealth and then just give it away to a nonprofit to just squander in many cases, as opposed to continue down a path and actually solve some of the life's challenges. I mean, you look at U.S. government with NASA and what they did, and then you look at what's happening right now with SpaceX as an example. So I think it's an interesting path forward. And I'm glad they're doing that. So any kind of final thoughts you want to leave our listeners with as we kind of wrap it up here? Because I think this is a tremendous space that I'm certainly going to be keeping my eye on. But any other trends or anything you want to leave us with before we kind of wrap up?
I just think it's a fascinating period. And again, like I said, I think you're at an inflection point. And I think that if we're in the third or fourth inning, what you're going to see is family offices become more sophisticated. You're starting to see some of the schools, Stanford, Harvard, Wharton, University of Chicago, put together programs. I think in 3 to 5 years, the brightest kids who want to get into finance, their first choice today is private equity or venture capital. I think that's going to start to morph into family offices. It's not there yet, but it's going to. I think family offices are starting to realize how to compensate people, because they have to compete directly with Apollo and Blackstone. So in order to get top talent, they have to compensate people, give them part of the carry, give them forgivable loans, different things like that. They're starting to do that. So we're at a really fascinating time when, again, it's going to happen. It's just a question of how long is it going to happen, because the money is there. There's that much money. And if you look at it, every major bank, law firm, accounting firm, they're all starting family office divisions. A lot of it's optics, but that's where all the money is. So with that money, with 10 trillion, with 65 trillion coming downstream, I think that family offices, whereas most people don't fully understand what they are right now, I think they will understand much more in the next 3 to 5 years. And I think you're going to continue to see them disrupt private equity and venture capital and become a major disruptor in many industries.
Great. Well, Ron, I really appreciate you coming on the show and sharing your wisdom with us. Where can people find more about you?
I'm fairly accessible on LinkedIn. I have a podcast, Family Office World podcast. It's Family Office World. I think it's familyofficeworldpodcast.com, which I just launched recently. But I'm fairly accessible by LinkedIn.
Nice. Well, I will put that in the show notes for all listeners who want to find more about Ron and from his podcast, as well as his wealth of wisdom. Please check that out. So thanks again for joining us, Ron.
Thank you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute. But before I do, there's a saying in the mining community, well, precious metals mining, that is, The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Ron Diamond. I really appreciate him coming on the show and sharing his wisdom about the family office space. I think it's really important on so many levels for everyone to understand how that works, not only how it works in general, but also people like to know so they could potentially apply that in their own lives. So now we're into the panel portion of our show where we have our very own Megan Gorman. Hey, Megan.
Hi, Kirk. How you doing today?
Doing great. Doing great. And we also have our very own Barb Friedberg. Hey, Barb.
Hello, hello, hello.
All right, well, let's start with our resident expert in family office in the ultra high net worth space, Megan Gorman. So, Megan, what did you think about the interview?
Yeah. So first of all, it was funny when I was listening to it, I immediately was like, oh, this is my world. But I think it's, look, I think that there's a lot of mystique about how wealthy families and individuals run their money. And this term multifamily office or family office is used all the time. And I think for most people, it sort of seems like this sinister Death Star that wealthy people have in the background, right? That run their money and get them amazing opportunities. But the truth of the matter is, and I think he touched on it quite well in the interview, is that a multifamily office really, is a way for a wealthy family to manage all the different levels of their wealth and assets, from tax planning to estate planning to investments. It all ties together. And yesterday I was in a meeting with a potential client, and it was interesting because they've not worked with a firm like this before, and they are clearly someone who could be with a firm like mine. And they were very focused on the investment part. And we kept saying, no, there's so many other things out here that are as important that need to be worked through. And so it's a lot of times forcing people to work through complex issues and family dynamics or things that they haven't really wanted to make a decision on in their wealth that ties into the traditional things like investing and getting your tax return done. So it forces a lot of complex planning, even if the ultimate decision from a family or a wealthy individual is that they don't want to go down this path. So I think what I'm summing up is saying that most of the time, people with means have just made more thorough decisions about what they're choosing to do because they're forced to navigate it by using a multifamily office setup. And so I think it's a great way for others to think about how they use their money.
Great. Well, appreciate that, Megan. And Barb, what were some of your takeaways?
250 million is a lot of money.
It's pocket
I'm
change.
like,
What are you talking about?
Because, you've heard the term family office bantered around quite a bit, and it's becoming more and more popular. As the guest remarked, this is really becoming a thing. Back when I started investing in the 90s and the 80s, you didn't hear about family offices, and maybe they weren't that popular then, or maybe the media just didn't cover them. But I always wondered, how much money do you really need for a family office? 250 million minimum? Well, that really rules out most of us. At least it certainly rules me out. So the other takeaway is, well, what can I learn from this that applies to my life as an investor? And I think the point is, we all at some point are going to need some legal advice. When my parents died, I dealt with a lot of attorneys over their estates. When I have legal concerns, I have to call an attorney. I have a tax person who prepares my business taxes, my personal taxes, whatever. Many of us have financial advisors. I happen to have the expertise to manage my own investments, but many people do not. So the question is, you need to make sure that your entire financial life is working in tandem. And I think that's one of the biggest takeaways that we can learn from talking about family offices, and also integrating, where does philanthropy fall in your life? Because clearly, with my donations, I doubt whether I'm going to cure any diseases. But that doesn't mean that my annual contributions don't make a difference. And do you think about that as well?
It's interesting, Barb, you brought up something, I think that is one of the challenges that the wealthy have, which is when you hear these numbers, 100 million, 250 million, there is this perception that these people don't have problems, right? That life is easy, but it's like more money, more problems, right? And I say this because a lot of times why a multifamily office is very, very beneficial, or working holistically, is you put the wealthy individual in the middle of the hub, and there are family members and friends all around them that they are actually a lot of times supporting, right? Or providing help to. And so I find that this perception of wealth at times makes it a very lonely place. And so one of the benefits of a multifamily office, and he talked about this, that sometimes a single family office sort of has blinders on, but when you have similar people with asset bases all getting advised by the same group, a lot of times they want to know what others are doing. And I bring this up because during the 2020 COVID crash in the market, a lot of our clients moved from fixed income into equities. And what they were focused on was this what everyone else is doing, right? Are the other people who are like me buying? And so sometimes I think it's that, trying to connect people. You can't connect them always because there's confidentiality rules, but to understand what others are doing and allowing them to feel that they're not alone is important. And so I always get worried when people think that wealthy people don't have problems. They all do. It's just at times amplified for the money. That's, and it's, by the way, they all know it's a champagne problem, but it is still a problem.
Yeah, no, it's a great point. The dynamics of wealthy people are different. And I think a lot of people wish, like, oh, if I had money, everything would be easy. No, your problems are just different. Like, you always have problems. They're just different problems.
Yeah.
So no, it's a great perspective. I appreciate you both bringing it up. So, so what's interesting is, when you get to this level with the single, with the multifamily office or single family office, where do the advisors fit in? Like, how does that all work, Megan, in your world? Like, where do you fit in if they're in a single family office, or do you? Like, how does that work?
Yeah, I mean, so it runs a couple different ways. Typically the family office is sort of the CFO, the ones who manage everything and manage all the pieces. Some multifamily office practices like mine have departments that deal with things. So we have a tax department. We do have a bill pay group, right? We have a bookkeeping group. We have an investment group. We have a research and audit group that all sort of work together to support the client. And then there are advisors that you work with outside. So for instance, at my firm, we don't draft, right? We do the strategy, but we use different attorneys. And so it's connecting with the right attorneys or the right advisors outside to provide services internally. And that helps to have a lot of these working relationships because it creates efficiencies. Because what it saves time for the client is that they don't have to do due diligence, right? You know, estate planning is one of these weird spaces where, you know, when you're dealing with certain types of asset bases, there are only certain types of estate planners you should work with, who are used to dealing with complexity and have very, very strong language in their documents to protect the client. So it's making sure that all of the connections are well diligenced to make sure that they can support the type of client. You know, I have found, in Kirk, I'm sure you found in your business too, that a lot of times when you have to apologize for something going wrong, it's actually not your own mistake. It's somebody you've connected a client with, right? Who've messed up. And that's the thing, when you have these type of multifamily office practices, it's about the relationships in that space. And I will tell you, when I look at sort of the talking heads or the thought leaders in personal finance, I typically don't see the ones who work with the ultra group. They tend to be more hidden.
Yeah, that's good insight. So Barb, you know, I know you don't have the same kind of experience that Megan has in this space, but you know, when you're thinking about this, how can people apply this kind of knowledge of family offices practically to their life? Because yeah, I'm sure there's some people who are wealthy listening to this, but probably most people are kind of mass affluent. So what are your thoughts? Like, how can people apply some of the lessons here?
One of the things that's come up a lot recently since 2000 is the private equity, the angel investing, the investing in companies that are not publicly traded. And there's a reason for that. Publicly traded companies in 1990, there were 8,000 of them listed on the New York and the NASDAQ Stock Exchange. Today, there are 6,000. So in order to be a publicly traded company, you need to have a certain amount of assets. You need to jump through a lot of hoops. You need to go follow a lot of SEC regulations. That's all very good for the public, theoretically. It gives you a certain degree of consistency. But the majority of companies in this country are private. And they're usually, they either fail or else they're emerging, they're growing. Many of them are growing very quickly. A lot of these high net worth people have access to those. And as Megan has talked about many times, and Kirk, you've discussed this as well, they come to financial advisors, vet their offers to them. So the question that really comes to my mind is, as an ordinary investor, first of all, if you have a financial advisor, you might be able to access some of these investments. There are also crowdfunding apps that promise to enable you to invest in private equity or smaller companies. Those are opportunities outside of the public markets. So you may be wondering, well, should I do that? Shouldn't I do that? If the public markets are shrinking, am I missing out? And I think that's a really important question to ask and for us to discuss. My opinion is you can do fine in the public markets. You don't have to invest in everything that's out there. But there are diversification opportunities there. It's not unreasonable to say, put a small amount of your money in these private companies, but what you're giving up is you're giving up liquidity. In most cases, when you invest in a private company, it's not like buying a stock where you plug in the ticker, you place your shares, you place your buy order, and you buy. And then whenever you say, oh, this company looks like crap, I need to get out. And then you sell it and you're sold. Boom, boom, boom. No problem with liquidity. When you invest in a private company, you're going to tie your money up for 3, 5, 10 years or more. And you're going to experience more risk. Yeah, you might get 20, 25% return a year, or you might get 0 return a year. So I think this is a really important issue. Love to hear from you guys. What do you think?
What do you think, Megan?
First of all, I think the private markets are fascinating, right? I think they've gotten larger over the past 25 years. Amazing investments are in the private markets. But I will also tell you a lot of the private markets is crap, right? It's access to the right opportunity set. So I think a couple things here is, I think one of the challenges for people is getting access to the right opportunity set. And that's where you have to do due diligence to see if it's truly worth the risk. The other thing I want to bring up is one of the things that's happened over the past year is Blackstone has a fund. It's a private fund. It's a private real estate fund. Starwood also has a private real estate fund. And these funds are private markets, private investing in the real estate market, owning multifamily homes and casinos and, storage and industrial REITs. And what's happened with these investments is they have very low minimums, but they're the private markets. And there's a lockup. And the lockup's there to protect the investors. And there's certain rules on withdrawals. And a lot of people got into these real estate funds in the past year. And when they wanted to take money out for a variety of reasons, the owners of the private real estate funds said, no, you have to comply with the rules of being in the private markets, which is there's lockups, and then you can only withdraw at a certain pace of play. And so I bring this up because when you are deciding to do this stuff, you have to really think about, one, is this an appropriate opportunity? Two, do I want to be illiquid to wait for the illiquidity premium? And three, am I willing to follow the rules that these plans have in place? And I think as you winnow through this, the private markets become less appealing for people. So I think my takeaway is, yeah, the private markets should be considered, but you really got to do due diligence on the opportunity set because there's a lot of crap out there. And you really have to understand the parameters of putting your money to work in the private markets.
Yeah, no, that's good insight, Megan. I've definitely got some thoughts on this too. So I think one thing I've noticed over the years is people tend to get fascinated with the shiny object. Whether it used to be hedge funds. Ooh, a hedge fund. Let's put money there. That sounds sexy, right? Because hedge funds were a thing in the early 2000s and it was exclusive to the wealthy and you couldn't get access. Now everybody can get access. Do you want to get access? That's a totally different question. And so when I see things like private equity, venture capital, people get excited about getting access. The question is, should you? And I think there's a lot to be said about private equity and venture capital. I think they are great vehicles if you're in the right buckets. Are you in the right managers? Are you getting the right deals? That's a totally different question. So, what I've noticed in the hedge fund space is maybe like the top X percent, let's call it 5. I'm not going to quibble over the percentages, but let's say the top 5% are really, really good. Everyone wants that 5%. There's 95% that are, average, maybe a little above average, and maybe below average, and then maybe terrible. So there's a whole bunch of stuff in there. People have access to that. I know a lot of hedge fund managers that would easily take money today, but it's so hard to raise money because nobody wants them. Oh, 20%? I don't want that. I want 30% a year. So you get this kind of like this big divisions, like the barbell effect, right? There's really like, a lot of people interested up here, and then there's a skinny end and nobody wants it. I don't know who would want the lower end, but anyway, it's a barbell that's one-sided. But anyway, you get the point, is that this kind of happens when people all want the best and nobody wants stuff that's just okay. And there's some managers I know personally that are really good. They do an unbelievable job, but it's so hard to raise money. And I think with private equity, it's the same way. One thing I noticed, and this is something that I keep tabs on a lot, is how do I know when a market is turned? Well, getting the good private equity deals, most people couldn't get access to. I mean, Megan might because of, connections or who she knows or whatever, but most people, average investors, are not going to get access to the best private equity deals in general. And yet in the last 12 months, I'm getting barraged with calls from private equity funds saying, hey, we got access. You want to get access to the private equity fund? Well, I know what's going on is that A, they can't get anyone else to invest, or they have people want to exit and they're trying to say, oh, you look at this shiny object. You can get into a private equity fund. Isn't that cool? And meanwhile, their buddies are going out the back door with the money you're sending in. I wouldn't be surprised if that's happening. And I'm sure Megan's not going to, so I'm sure that is happening. But the point is that, to get the best, if you're not 250, 500 million, $1 billion. If you're not in that category, you're probably not going to get access to the best. So should you even look? That's another question. I personally don't think that you need, and this is coming from a guy who specializes in alternatives held in retirement accounts. And we get a lot of activity with alternatives. I don't think alternatives are necessarily the best. Just because you're in an alternative investment or you're in a private equity fund or you're in private stock, it doesn't make it better. It can be great, and it can be terrible. And there are just different dynamics going on with private investments than public. So if I make a mistake in public equity, I can just sell it a second later. Oh crap, I made a mistake. I, mistranscribed a number and it looks terrible. So I sell it, right? I can do that in the public markets. In the private markets, you can't do that. You're tied up. Oh, you're going to make a private investment? You better be darn sure, because you're not getting that money back until there's a liquidation event. These are some of the challenges that people face. And I know Megan has this experience, and I want to get her input on this, but they're just different challenges. Are they better or worse? I don't know. Personally, I would not want to be in illiquid investments in a market like this. I would rather be in liquid investments that I could liquidate at seconds notice for whatever reason. And I could decide if I want to buy into illiquid investments. You know when the best time is? At the bottom of the market, when everyone's trying to run out of there, and they'll take 20 cents in the dollar because they just need liquidity. That's the best time to buy illiquid investments. So if I was a patient person, which I am, I would just wait for that and just pick up all the bargains when people are screaming to run out of a screaming fire to run out of a theater. I think that's the time to do it. You just sit in the outside and just pick up the deals. So I don't know, Megan, what are your thoughts?
It's funny that you bring up illiquidity, because one of the things going on right now is there are a lot of people who overcommitted to private investments over the past few years. And so what's becoming very appealing right now is the secondaries market, whereas as you know, like a private equity or venture fund is usually a 10-year commitment. And some of these funds are being sold and they're in year 4, 5, where you can put your money in and get distributions sooner. So yeah, I mean, when we work with clients, and I think everybody could do this in their own portfolio, we in our investment policy statement make a decision about illiquidity and what percentage we're willing to accept of illiquidity in a portfolio in terms of getting return. And so at the same time, what we do is we also map out vintages, where every year we're deploying into the private market a certain number of dollars of commitment. Doesn't mean that much dollars go in that current year. And I bring that up because there's something so sexy about the private markets. They really are. I mean, everybody wants to be the guy who invests in or guy or gal who invests in the next Facebook, but it's a very complex market. And once you invest in it, it's like investing in a black box, because you don't really hear much about it except to get capital calls. So I think that anyone who wants to go into this space really should, on their investment policy statement, map out what their goals are with it, what type of illiquidity they're willing to accept, what are their parameters, and really think it through, because you are committing to a very long period of time to not get access to your dollars in there. So it's a tough thing, and I think it's going to get harder for investors, regardless of net worth, because there's going to be a lot of stuff thrown at them. And, you hear more and more about this stuff. But Kirk, you brought up a really important thing, which is, when funds are seeking out investors really easily, it means they're having trouble raising money from their existing investors. Most of the top tier funds are already committed to year after year, vintage after vintage, and they're going back to the same sources for it. The last thing I'll say, and this is sort of interesting from a mindset standpoint, I do work with a lot of venture capitalists. And when we go through their net worth, whenever we go through the value of their own funds, they all say the same thing to me. I don't really count that towards my net worth. I assume it's zero. Okay. So it's an interesting mindset, because they then go more into that scarcity mode. So you could have someone with a 9-figure balance sheet who really only thinks they have a lot, like a tenth of what they have. And so what is interesting in that mindset is a lot of my venture guys are heavy in private. And like you talked about barbelling, Kirk, they are pretty heavy in fixed income to try to cut the volatility. So it's interesting, those mindsets that I see in managing their portfolios and how they view the asset base. And it's something that we have mapped out with them in their investment policy statement. So again, the investment policy statement becomes a really big tool for people in managing their portfolios.
Yeah, that's great insight. Barb, what are your thoughts?
You need to think about what is a reasonable rate of return for you. If you're in your 30s, 40s, early 50s, you're really probably looking at growth. So you probably want a more aggressive portfolio. You can be comfortable with a heavier stock-related portfolio because although we've experienced kind of a bad year in terms of returns with stocks in 2022, historically stocks, U.S., international, publicly traded equities have given you a very nice return year over year. And if you think the businesses of the US and global economies are going to grow, then you can be confident, maybe not as higher returns as we've had in the past because they've been pretty high, but estimate an 8% annual return. That's lower than the historical average for equities, but your money's going to double, pretty fast at 8%, probably, 9 years, something like that. So and if you keep putting in more, you're going to get a very nice rate of return. If you get older, you've got more capital built up, you're closer to retirement, in retirement, you have to ask yourself, do I need to strive for the highest return out there? Or can I be involved in more capital preservation? Right now, in the fixed income market, in short-term treasuries, in money market accounts, you can get 4%. If you have a $1 million portfolio, 4% of that is $40,000 a year. That's a nice addition to a retirement check every year to get you very close to your spending without even touching your principal. So, Kirk, you mentioned you were patient. I am also very patient. I am also not greedy. And so I think the people that are greedy are the ones that get hurt. They're striving for any way to get these crazy, crazy returns. Be reasonable. Look at your goals. And Megan talks about investment policy statement all the time. Look at your goals. Look at what is a reasonable, achievable rate of return. Determine an investment strategy where you can realistically, over 10, 20, 30 years, get a reasonable rate of return that will help you meet your goals. If your goal is to be the richest guy in the room, well, that's one thing. But for most of us, being able to meet our needs now and in retirement is a viable goal. And having more doesn't necessarily make your life any better. And it will it doesn't remove your problems, and it can create a lot more risk in your investment portfolio.
Yeah, that's great insight, Barb. And I think it's, one of the things that we try to convey on the show is help people change their minds on how to think about investing, right? There's no single path. I think we've all been conditioned in the last, 20 years of doing things in a certain way, or 40 years in some ways. And, I think people just need to understand cycles and how markets work. And you don't always make money. Every year you do not make 8%. That is historically anomalous, even though that happened in the last 10 plus years. That is not normal, but yet that's what people expect. So I think the thing to take away is, as you said, Barb, like, hey, if you're getting 4.25%, that's pretty good, especially compared to Jeremy Grantham, who came out today and he warned of the S&P going down 17% this year, with 3-to-1 odds of that happening. Now, I find that interesting. Is he right? I don't know. I know one thing about Jeremy, like he tends to be right, but he also tends to be early. And he's got a really good track record of being right in 97, in 2005 or 6. What you notice about that is he was correct about the bubbles, but he was also early by 2 years. So he has a great track record of being early but correct. So, when you hear stuff like that, it just to my mind, it's like, okay, that's interesting. But you should also take into the fact that the markets don't always go up. I mean, remember the early 2000s when the markets went down for a few years in a row? From pretty much 2000 until 2003, early 2003, right before the Iraq War, the markets pretty much went down. And then, and of course, in 2008 was a bad year. So just understand that the markets don't always just go straight up. That they do cycle. They do have different trends that vary. And so you just sometimes 4.25% is good enough. I'm not suggesting it's for everybody, but sometimes just taking a small gain is better than the big loss. And I think, a lot of people don't think that way. And the fact is, a lot of people have made a lot of money over the last few years. If they were taking high risk, investing in high risk investments, then that high risk goes the other way too. And most people don't have that experience. So when it happens to them, they get a little squirrely. So I think as Barb said, it's, performance, just be mindful of the performance expectations that you're having. So I did want to ask like one last question here, and then we'll wrap it up. Is Wall Street dead? I kind of feel like it's got a slow spiral. It's a slow death. For the last 20 years, it's just been getting pecked to death by reality. And I don't know, Megan, what are your thoughts?
Oh, I think rumors of death is greatly exaggerated, right? That whole quote. No, Wall Street makes too much money. So no, but it's the same players. Everybody just takes on different shapes, right? I mean, that's sort of how it's always constantly evolving. But I don't think Wall Street is dead. Do I think that investors have gotten savvier because of technology and the internet? Yes. But I also think it puts investors at more risk at times because there are more investments out there that aren't appropriate. That's much easier to get access to. So to answer your question, no, I don't believe Wall Street's dead. There's just too much money.
All right. Barb, what about you?
I thought there was an interesting aside that our guest made. I don't know if all of you heard it or not, but he said much of his investments in the public markets are in passively managed index funds. Now, those are the companies in those are publicly traded. They are they're listed on Wall Street. And what he was saying and what the research says is that it's very tough to beat the market. It's very tough year in, year out to beat a passively managed index fund portfolio. So, like Megan, Wall Street is not dead. But the best way across the board to invest is to diversify. And if you don't have one segment of your portfolio that you hate, then you're not diversified enough.
Yeah, I agree. I think that's I love that quote there, Barb. So in the interest of time, we got to wrap it up. But Megan, final thoughts from you.
Yeah, so I think two things. One, investment policy statements. All of the best family offices insist on there being a mandate for what's going on investment wise. So I think it's a good thing to copy. And then I think the other thing you need to build out for your financial life is just a simple one pager of who handles all the different parts of your financial life. Who is your tax preparer? Who is your estate attorney, your insurance agent, your financial advisor, right? All of those different things. Because if you have all of them on a one pager with your investment policy statement, it also forces you throughout the year to make sure you check in with each of them, to make sure, is there anything that you should be doing? And I think you have to think about the fact that all of the people who advise you, you should be in a conversation with, even if the conversation has lulls in it. And that's what I think that wealthy families do quite well by having the multifamily office set up. But it's something that can be easily be replicated for all of us. So I'm Megan Gorman. You can find me at Forbes.com. Thanks for having me on, Kirk.
Thanks for coming on, Megan. Barb, final thoughts from you.
Less is more. Less futzing with your investments. Less trying to time the market to choose the absolute optimal way to manage your money. less looking at your investment values every day. Because markets move very slowly. Investing is not a short-term gain. If you need your money in 2, 3, 4 years, then it should not be in the investment markets. Those dollars that you need relatively soon should be in liquid money market mutual funds, CDs, that sort of thing. So I am Barbara Friedberg. You can find me on YouTube and at Barbara Friedberg Personal Finance.
Great. Thanks for coming on, Barb. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.